Friday, January 30th, 2026. This is a date that will be etched into the memory of every trader and investor. What started as a seemingly normal trading day quickly spiraled into a historic collapse. We witnessed a financial event of staggering proportions, a true black swan. In a matter of hours, silver plunged into a catastrophic freefall. The numbers were almost unbelievable. The carnage was global. In the United Kingdom, silver hit a high of £115 per ounce. It plunged down to just £73 per ounce. That's over a 30% drop in a single session. Across the Atlantic, on the COMEX exchange, front-month silver futures plunged intraday by about 30%, and at times an astonishing 36%. Gold, the king of metals, was not spared. It fell more than 12% and crashed below the critical $5,000 per ounce level. This was the largest single-day percentage drop since the early 1980s. What makes this event particularly perplexing is the data coming from the derivatives market. The price action screamed panic and a mass exodus, but the underlying contract data told a different story. Trading volume on the COMEX was incredibly high, yet open interest barely budged. At the close of trading, open interest stood at 156,467 contracts. That was a decrease of only 305 contracts from the previous day. Such a small change suggests this wasn't a market-wide flight. It points to something more targeted and technical. This contradiction between price, volume, and open interest is the central mystery. Normally, a massive price drop with huge volume would be accompanied by a big decline in open interest. The fact that it didn't happen points to a different kind of event. It suggests a powerful, concentrated force could move price without changing participant counts. Was this a massive, coordinated clean-out of leveraged positions, or was it something else entirely? The clues might not lie in the paper markets of the West. As the dust settled in New York and London, a starkly different picture was emerging from the East. While Western markets were in a state of meltdown, the physical silver market in Shanghai was telling a completely different story. There, the price of physical silver remained remarkably firm, trading at around $123 per ounce. This stood in stark contrast to the Western paper price, which had collapsed to levels near $78. This created an unprecedented premium of nearly $19 for physical silver in the East compared to the paper-traded price in the West. Such a massive divergence is not just a statistical anomaly. It is a fundamental signal of a deeply fractured market. This chasm between the paper price and the physical price is at the heart of the debate raging in the aftermath of the crash. It raises a critical question. What is the true price of silver? Is it the price determined by futures contracts, ETFs, and other financial derivatives on exchanges like the COMEX? Or is it the price people are willing to pay for actual physical bars and coins in a real-world marketplace like Shanghai? This event has thrown a harsh spotlight on the two parallel universes of the precious metals world, the paper market, driven by speculation and leverage, and the physical market, driven by tangible supply and demand. The dominant narrative quickly centered on three potential causes. First, forced selling. Many analysts believe the market had become dangerously over-leveraged, particularly among short-term traders. A sudden catalyst could have triggered a wave of margin calls, forcing these traders to liquidate their positions at any price to cover their debts, creating a downward spiral. Second, a policy shock. News that the Trump administration was preparing to nominate Kevin Warsh, a known hawk, as the next Fed chair sent the US dollar soaring, putting immense pressure on all commodities priced in dollars. Third, and perhaps most explosive, deliberate market manipulation, a battle between East and West. Proponents argue Western banks use the power of the paper market to artificially smash the price, possibly to clear out bullish positions before the physical settlement at the end of the month. The resilient price in Shanghai, where physical demand is king, is presented as evidence of the real market price. In this essay, we will dissect each of these possibilities. Was this a natural, albeit brutal, market correction driven by leverage and policy news? Or was it a calculated strike in the escalating war between the paper and physical markets? To truly understand the chaos of Friday, January 30th, we must first look at the days and weeks leading up to it. The precious metals market didn't just fall off a cliff out of nowhere. It had been climbing a precarious mountain. For months, gold and silver had been on a spectacular run, fueled by concerns about global inflation and geopolitical instability. This breakneck rally attracted a wide spectrum of investors, from seasoned institutions to a new wave of retail day traders. The excitement was palpable, but so was the risk. The market had become, in the words of one strategist, highly bubbly. A dangerous level of leverage had quietly built up beneath the surface of the rising prices. It had become incredibly crowded on one side of the trade, with almost everyone betting on the same outcome: higher prices. This created a situation ripe for what is known as a gamma squeeze. The market was essentially a coiled spring, wound tighter and tighter with each passing day. It had become incredibly crowded on one side of the trade, with almost everyone betting on the same outcome: higher prices. This left it extremely vulnerable. Only a small spark was needed to ignite a fire. In the final days before the crash, silver had been particularly hot. It had just hit a record high of nearly $122 per ounce on Thursday. This success, however, was its Achilles heel. As Matt Maley noted, silver had become the hottest asset for day traders and other short-term traders. The market was functioning like a crowded theater with only one exit. Everyone was enjoying the show, but if someone yelled fire, the resulting stampede was destined to be catastrophic. The market structure was fragile, resting on a foundation of borrowed money and optimistic sentiment. Any piece of news that could challenge the prevailing narrative had the potential to trigger an avalanche of selling. The calm before the storm was about to give way to a historic tempest. The spark that lit the fuse came not from a trading desk, but from Washington, D.C. Early on Friday morning, reports began to circulate that the Trump administration was preparing to nominate Kevin Warsh for Fed chair. To the average person, this might seem like arcane political news, but to the financial markets, it was a bombshell. Warsh is a well-known figure, widely viewed as a hawk. This means he prioritizes fighting inflation, is more inclined to raise interest rates, and would likely maintain tighter monetary conditions. This news hit the commodity markets like a punch to the gut. For months, assets like gold and silver had benefited from a relatively dovish Fed. The prospect of a hawkish Fed chair completely upended this calculation. A Warsh-led Fed would likely mean higher interest rates and a stronger U.S. dollar. Since gold and silver are priced in dollars, a stronger greenback makes them more expensive for foreign buyers, reducing demand and putting downward pressure on prices. The U.S. dollar immediately reacted, staging a powerful rally. This rebound was the primary trigger for the initial sell-off in metals. It undercut the bullish sentiment. Investors who had piled into gold and silver suddenly found their core thesis challenged. The nomination wasn't a certainty, but the mere possibility was enough to spook a market that was already on a knife's edge. It was the perfect catalyst to pop the speculative bubble. This initial dip was all it took to start a chain reaction. The political catalyst had done its job. It had pushed over the first domino. Now, the internal mechanics of the market itself would take over, transforming a modest downturn into a full-blown crash. As prices began their initial descent, the second phase of the crash kicked in: the domino effect of forced selling. This is where the story shifts from a policy shock to the brutal mechanics of leverage. A margin call is a demand from your broker to deposit more funds. If you can't or won't meet the call, the broker has the right to forcibly sell your assets. On a day like January 30th, thousands of margin calls went out simultaneously. This process creates a vicious, self-reinforcing downward spiral. It becomes an avalanche, gaining speed and destructive power as it thunders down the mountain. The price is no longer moving based on fundamental analysis, but on the desperate and automated need to liquidate positions at any cost. This explains how the drop accelerated so rapidly. The enormous volume was the sound of highly leveraged long positions being systematically and violently unwound. The fact that open interest remained stable is the key piece of evidence. The contracts weren't being closed by choice. They were simply being transferred from weak, leveraged hands to stronger, better capitalized players who were able to absorb the selling pressure. It was a cleanup, not a market-wide exodus. As if the political news and the cascade of margin calls weren't enough, a third factor came into play. Amid the chaos, the CME Group made a crucial announcement. Citing the extreme volatility, they declared they would be hiking margin requirements. This was the second such hike in just 3 days. Effective the following Monday, maintenance margins were set to rise by a staggering 36% for silver futures and 33% for gold futures. It was the market equivalent of pouring gasoline on a fire. Traders knew that if they wanted to hold on to their positions, they would need to come up with significantly more capital by Monday. For many, this was an impossible task. The CME's decision effectively forced even more liquidation. This regulatory hammer blow was the final trigger. The combination was a perfect storm. Each trigger fed into the next, creating a feedback loop that sent prices into a historic nosedive from which they could not escape in a single session. To grasp the mechanics, we must understand the paper market, a world of financial instruments that represent an underlying asset, like silver, without being the physical asset itself. This financial architecture allows for activities that are impossible in the physical world. The most notable of these is short selling. Short selling reverses this process. A trader borrows an asset they do not own and sells it on the open market, hoping the price will fall. If it does, they can buy the contract back at the new lower price, return it to the lender, and pocket the difference as profit. You cannot short sell a house you don't own. In the physical world, you must own an asset to sell it. But in the financialized paper market, this fundamental rule does not apply. This creates a disconnect between the price discovery happening on screens in New York and London and the actual supply and demand for physical metal. The crash on January 30th exposed this disconnect in the most brutal way possible. The historic crash was not from a single cause. It was a perfect storm. A policy shock was the spark. The landscape was soaked in gasoline, dangerously over-leveraged. The paper market mechanics took over, and a regulatory action from the CME was the final hammer blow. The COMEX data is the evidence. Sky-high volume with flat open interest is the classic signature of a forced cleanout, a violent internal reshuffling of the deck. This crash exposed the profound disconnect between the paper and physical markets. While the Western paper price was in freefall, the physical price in Shanghai held firm, creating a massive premium. That divergence shows robust physical demand and suggests the COMEX price had become untethered from reality, distorted by the forces of leverage and speculation. As we move forward, investors must remain vigilant. Key areas to watch are further regulatory action from the CME and potential investigations from regulators like the CFTC. Monitor the flow of capital. Will investors, burned by the paper market, move money into physical assets? Watch COMEX inventory levels and retail premiums for signs of this shift. The geopolitical and policy landscape remains paramount, especially the next moves from the Federal Reserve. The East-West dynamic, reflected in the Shanghai-London price spread, will be a crucial barometer of market health. The crash of 2026 was a harsh lesson. The road ahead will be defined by the struggle between two worlds, the world of paper promises and the world of tangible property. The question remains, which one will ultimately determine the true price?